I was a bankruptcy attorney, bankruptcy litigator for over 10 years, and moved on to the buy side of distressed assets at a hedge fund. And so I was buying bankruptcy claims and other kind of stressed and distressed assets, including class action claims, subrogation claims, for almost 20 years. And the industry really hadn't changed throughout that period of time. And so myself and Vladimir decided that it was time to bring the claims trading business and put option credit protection business into the 21st century. And we created the bankruptcy claims market, as well as the claims put market, where vendors who own claims in a bankruptcy case can list those claims for sale on the exchange at a given price. And then we have over 30 investors in claims, many of which who are not vertically integrated and rely on exchanges and brokers for claims. They then compete to meet the listed price for the sale of that claim. If they meet that price, there's a transaction to be done. Documents are pre-approved, and documents are pre-signed by the seller. So the buyers have the confidence that they can execute quickly and efficiently with a minimum of time and expense. And the sellers, recognize that they're either going to get the price that they're listing their claim for, or they then have the option to accept any counterproposal that they might receive on the exchange. So it creates efficiencies for both buyers and sellers of claims, which had not existed in the marketplace previously. There's been other attempts at a exchange of bankruptcy claims, but we have the first exchange that's actually productive and has been up and running now for almost 2 years.
Who buys these kind of claims? Is it specialized companies or divisions of hedge funds?
Predominantly, it's either hedge funds or investors who specialize in investing in bankruptcy claims and other illiquid financial assets. We have onboarded on the exchange everything from $60 billion hedge funds to guys with a few $1 million who are investing in bankruptcy claims and other assets. And so it runs the gamut, and we can provide for the exchange of relatively small claims on the exchange, as well as multi-million-dollar claims.
And how do you guys get paid?
So the seller of claims, never has any fees or expenses. The buyer pays us a small fee, typically about 0.5%. The real value proposition for Cherokee is creating an exchange that has its own intrinsic value. We think that as the industry develops and the exchange becomes more widely accepted and becomes the go-to place for transactions, that the exchange itself is going to have value for us. Cherokee, in its own right, also purchases bankruptcy claims. And so one of the questions I often get asked is, well, is there a conflict between the over 30 investors on the site and Cherokee? And, obviously something we contemplated and provided for. Cherokee is not able to be a bidder on the exchange for at least 5 days. And this gives the investors on the exchange the opportunity to provide a price or meet the seller's price. And only if that price is not met can Cherokee step in and also bid for the purchase of that asset. And again, I mean, we developed the exchange not to buy claims for ourselves, but to create an exchange that has its own value.
Why would claim buyers want something like this? Because I would think one of the benefits of buying a bankruptcy claim is that You know, it's such an illiquid market that you don't have other buyers. You don't want to have other buyers. So why would they want an exchange where you're actually encouraging a competitive environment?
It's a good question. So it's extremely rare that a buyer can find an asset that is, does not have competition. And so, what this exchange does is provides product to the investor that they ordinarily would not have access to. We have been buying claims for over 20 years, and so we have a deep database of relationships that we can access in a particular case. They know us, they trust us, they know our documents. And so, sellers are comfortable selling their claims with us, and the buyers have already approved the standard form document. And so, as I mentioned earlier, it just makes it so much easier and more efficient for the buyer to buy the claims. Number one, they don't have to go out and source these claims themselves if they even have the capability to do so. And number two, there's not an issue of negotiating the document. It's the document's pre-approved. If you're a very large hedge fund, you ordinarily would not really care to purchase $1 million claim. It's just the time and expenses associated with that transaction would be prohibitive. But on the exchange, where the documentation is good to go and pre-approved, they can literally press the button, accept the seller's proposed price, fund the transaction in 48 hours, and they own the claim. It becomes that simple. And so it's a huge benefit to the buyers of these claims.
What if a claim is later objected to? Let's say there's a you buy a claim and there's a later claim objection. How is a buyer protected?
Sure. So fundamentally on these transactions, the buyer is assuming all the risk with regard to distributions on the claim. When and if there's a distribution, how much that might be, even the nature of the distribution, whether it's cash, equity, or a note, whatever it might be. The risk that the buyer does not take is that they're sold an amount of claim that doesn't exist. And so the distinction is amount of claim versus distribution of the claim. And ordinarily we would not list a claim that is not scheduled by the debtor as a clean scheduled valid claim, stipulated or otherwise. And so it's a rare scenario where a claim with that status would be objected to. And if it was objected to, and if the amount of claim was reduced, there'd be a recapture of the proportionate amount of funding for that portion of claim that did not ultimately exist. A buyer is not going to buy and pay for something that that's not there at the end of the day.
On that same note, when does the buyer actually pay? Does the buyer pay half and then wait and see if there's an objection, or just pays the full amount right away?
Once the pricing is accepted, the buyer is funding the transaction within 48 hours to the seller by wire transfer. And it's important to note that these are direct transactions. So there's privity between the buyer and the seller. Contract is between the seller of the claim and the ultimate buyer. Cherokee and the exchange does not sit in the middle of these transactions.
Does Cherokee provide any analysis, like, so buyers are, let's say not professional buyers could do an analysis of what the payout is going to be. In other words, do you provide like a monthly operating report or a liquidation analysis or help in getting that, or you just have the exchange?
Well, what the exchange provides for, which again is not available generally, is also very helpful to buyers and sellers of claims, is a historical chart of pricing on these claims, where transactions have gotten done, where the market is currently. We don't provide any formal analysis to buyers and sellers. Usually, if you're a buyer of a bankruptcy claim, you've done your own analysis. If you're a seller, you're familiar with the case. You're familiar with the proceedings. And then you, of course, have access to creditors committee counsel and or debtors counsel if they want to kind of access information. We're not, a registered financial advisor, so we're not going to be providing, analysis to either party.
Let's say I'm only interested in buying, an admin claim. Is that, can I sort by admin claims or type of claim, or I'm just going to look and some of them are going to be admin claims?
Sure. Well, so the way that the exchange is set up is that it's set up by debtor. So if you're looking at LATAM Airlines or Aeromexico, you look on the site and see what, if any, offerings there are currently, and if you're an investor who's onboarded, you automatically get notifications sent by email when there's a new listing. And so if it's something that they're interested in, they also have access to the diligence materials on the exchange. A copy of the Schedule F, a copy of the stipulation, a copy of the claims register. It's all right there for ease of the buyer's, analysis and bidding on that claim.
What would cause a change in the price? Do you have like a news coming out, or do you have, let's say, a disclosure statement and plan is confirmed? So before that, it's a certain price. After that, it's another price. Or is it more news driven? Or what, in your experience, what causes those change?
It's all of the above. Bankruptcy claims have volatility, just like a stock or a bond. If good news or bad news comes out, either specifically with regard to the case, or as you mentioned, a disclosure statement is filed, and there's more, certainty as to whether a recovery might be, that might move pricing higher or lower. If oil pricing shoots up and you're an airline, and that eats into profits, recoveries may be deemed that they're going to be lower, and pricing could go lower. We've also seen, for instance, in the LATAM Airlines case, transactions relatively early on with pricing, in the 60s, approaching 70 cents on the dollar for the parent company claims, and today, they're in the teens. And so, there can be extreme volatility on these claims depending on, perspectives on recoveries, timing, and terms within a disclosure statement and plan.
Do you have secured claims, bankruptcy secured claims on the site?
Yeah, I mean, any bankruptcy claim can be listed on the exchange, whether it's a secured claim, a lien claim, an administrative claim, a general unsecured claim. They're all available to be listed and traded on the exchange.
Are you making a decision to focus on big cases because there's going to be interest there, or you're just that's where sellers are coming from?
That's where transactions are getting done. And so, if there's seller interest and buyer interest, those will be the cases that are identified on the exchange. There are tons of cases where, there's little or no recovery, or little or no, interest in, by buyers for those claims, and they're typically not going to be listed on the exchange. The idea is to create efficiency for sellers, so that they know the transactions will get done, and provide offerings to buyers that they're going to care on, or somebody will care on. And so it is a curated exchange. Similarly, if a claim is typically transacting at hypothetically 20 cents on the dollar, and somebody wants to list it for 50 cents on the dollar, we're not going to list it at that kind of price, because it's just outside the realm of reasonableness. But if somebody wants to list a claim at an aspirational price, if things are trading at 20 cents and they want to list it at 23, 24 cents on the dollar, that's something that we'll do, and then we'll see what the market will bear, and whether any investors want to step up to that kind of price, or if investors have a pricing counter proposal. As I mentioned earlier, the seller always has the opportunity and option to accept a counter proposal on the exchange. And so it creates optionality for a seller and enables a bidder to bid, at a price that they think is reasonable for the purchase of that claim.
Are you getting, mostly sophisticated Forbes 500 type listers, or are you getting like mom and pop companies, or all kinds?
Typically in the larger cases, there's sophisticated companies that have CFOs, sometimes Fortune 500 companies. You'll see, the sellers are identified on the exchange. There's probably more Fortune 500 sophisticated companies than not. I think people who are educated and confident are more likely to be a seller of claims than others. And part of what we try and do when we speak to sellers is, provide them some guidance and some information so they can do their own diligence on the value of a claim, make their own decision as to whether or not it makes sense to sell the claim, because that's how kind of the smaller claim holders get comfortable with the process and with pricing.
Let's say someone has a small company has an admin claim or a reclamation claim, and it looks like they're going to get paid 100 cents on the dollar. You'd point that out and say, you shouldn't sell for 10 cents on the dollar. I mean, would you provide, advice like that?
Well, sure. Administrative claims will oftentimes be a function of present value, how long this case might last, what kind of issues there are in the case, and administrative claim pricing is typically relatively high. And so if a creditor would just assume take 90 cents on the dollar today, as opposed to taking the risk on timing on administrative claim, and for that matter, whether or not the case is administratively insolvent, that's where we see sellers of administrative claims.
Well, let's say you have a buyer who's a mom and pop or unsophisticated. So what advice would you give to someone? Let's say someone wants to buy administrative claims, and the payout is going to be, let's say, 100 cents on the dollar, and they've got to do a present value analysis, and they've got to figure out, when the payment is actually going to be. Would you provide someone like that with resources or advice and say, look, you're likely to get a payout 2 years from now, or how would someone find that out?
Other than the basics, I mean, we're not really in the business of providing advice to buyers. All of the buyers on the exchange are sophisticated investors. It's very rare that an investor in bankruptcy claims is not aware of the fundamentals like administrative claim status or unsecured claim status. And I'm not aware of any buyer on the exchange that has not had a history and experience buying bankruptcy claims.
I'm just going to throw this out. I know there's case law that says that, there could be an entity buying bankruptcy claims in order to dominate the voting on a Chapter 11 plan and maybe reject the plan, or, in other words, have some motivation besides appreciation or income. Do you see buyers like that on your site, or you wouldn't know?
No, I mean, look, I've been doing this for a long time. I hear that comment pretty frequently. It's extremely rare that there's a buyer out there who's trying to take control of the case through bankruptcy claims. It's nearly impossible to do it through bankruptcy claims. A buyer would be purchasing bonds or bank debt or other unsecured debt in large quantities in order to get that kind of a position. And to get a controlling position through bankruptcy claims, while it might help with their other investments, it's very rare that it's going to be independently enough to control a case.
Has your site ever been used in litigation with respect to establishing, let's say, a liquidation value for the company? Or so in other words, let's say a bankruptcy lawyer goes to your site, say, Your Honor, these claims are trading at X, and this is evident, using your site as evidence of the value of the company, or what the payout is likely to be, or something like that.
The historical claim pricing is available to the public, so it can be used as any litigator may deem appropriate if they wanted to. We spend a lot of time talking about bankruptcy claims. We also provide put option credit protection, which is a contract to purchase a bankruptcy claim at a predetermined rate. And a lot of vendors use this to protect their accounts receivable from a particular retailer. And we also have a similar exchange for put option credit protection. Operates the same way. A vendor to a retailer lists a put option at price on the exchange, and investors can become their counterparty on the exchange. So very similar concept on a similar product, but not quite, not the same product.
Let's take Sears as an example. Before they file for bankruptcy, if you're a vendor selling furniture that's being sold by Sears in one of Sears stores, and you're worried that Sears might go bankrupt in the future, what would you do?
Sure. So there was an active market in put option credit protection in Sears. Going back to the first filing of Sears Kmart back in 2002, I think it was, and subsequently. So a vendor might be selling a good or a service to Sears, and they want to make sure that they're not going to get caught with a bankruptcy claim. They can list an amount of coverage and a duration of coverage on the exchange.
So let me just so people understand, because I don't understand. So let's say there were 100K in receivables. Okay. I'm owed 100K in receivables, and I don't know anything about bankruptcy claims, whatever. And I'm worried that they're gonna stiff me when they go bankrupt. So how do I protect myself if there is a bankruptcy file?
So the put option credit protection product is not receivable specific. It's amount and duration specific. So the vendor is electing an amount of coverage for a specific duration. So if they had $100,000 of receivables that they wanted to have covered for 6 months, they could list that on the exchange for a given price, whatever it might be, 1% or 2% per 30 days, and hypothetically. And if there's a counterparty out there who would accept that risk, the risk that if Sears filed bankruptcy within that 6-month period, that the vendor can then put up to $100,000 of their account receivable, of their claim, to that investor, they can do that.
So the investor would have to pay the vendor $100,000?
No. It's bankruptcy triggered. So they're electing, up to $100,000 of put option credit protection. And so if they had a bankruptcy claim of $100,000, they're able to put that claim to the investor. And
what does that mean? What does that mean? Put that claim. So they have $100,000 claim in the bankruptcy. And what does that mean that they can put that claim to an investor? What does that mean?
In its simplest terms, the put option credit protection is a contract to buy a bankruptcy claim at a predetermined rate in the event there's a bankruptcy filing within the period of coverage.
Got it. And so the rate would be agreed to beforehand. So the other person on the other side of the contract would agree to buy the $100,000 claim for what, 50,000 or something like that?
Typically, it's anywhere from 1% to 2.5% per 30 days. And so for using 1% per 30 days for 6 months, they would pay 6 points to give the vendor the option of putting their bankruptcy claim to the investor for that predetermined rate of recovery, whether it's 90 cents on the dollar or 100 cents on the dollar.
For a predetermined rate of recovery. Okay. So there would be agreement that the entity to whom I'm selling this put would buy the bankruptcy claim for a predetermined percentage.
Correct.
So in other words, you're paying someone insurance in case there's a bankruptcy, and you're going to be somewhat covered. If there is a bankruptcy, you get some protection.
It's not insurance per se, but it is a put option contract where the vendor can put their accounts receivable to the investor if there's a bankruptcy event within that period of time.
Okay.
And this has been a business that myself and Vladimir from my office originated back in the late 1990s. It's grown dramatically over the past 20 plus years, and also hadn't really changed in the last 20 years or so. And we just, at the same time that we created the claims market exchange, we created the claims put market exchange.
So put sellers are hoping there's not going to be a bankruptcy, basically. They're betting that there's not going to be a bankruptcy.
Correct. Or they're betting that if they have to buy a bankruptcy claim, that they don't mind buying that bankruptcy claim at the rate determined, with the offset of the fees that they received as well.
Is there a standardized rate for each, on an exchange? You would think there would be standardized rates, no?
The rate depends on the credit risk of any particular entity. So it can vary very, very dramatically, from anywhere from 50 basis points per 30 days to sometimes over 3 points per 30 days. You're
buying a put, there's a bankruptcy. Now the entity that sold you the put has to buy the claim from you. Now the amount that the percentage that you're going to get paid on your $100,000 claim, that's going to be individually negotiated with every single put that you buy.
That can vary. I mean, typically it's 100 cents on the dollar payment in the event of a bankruptcy. Oftentimes it could be 90% depending on the risk. And we've written puts where recoveries are as low as 40 to 50 or 60 cents on the dollar as well. Again, depending upon the risk associated with that particular credit.
So these puts get more and more expensive the more likely the company, if there's a news item coming out, Sears, is consulting with restructuring executives, then the price of the put is obviously going to go up.
Goes up, or it becomes unavailable. However, the put option credit protection product is different than credit insurance in that it's non-cancelable for the period purchased. So if you buy 6 months of coverage, that coverage cannot be taken away during that 6-month period. Whereas traditional credit insurance from the traditional insurers is typically able to be withdrawn upon a certain period of notice. And so it provides a higher level of comfort to a vendor buying a put option credit protection product as opposed to credit insurance.
Who sells these puts? Is this hedge funds, specialized hedge funds?
Exactly, yes. And typically where the put option credit protection comes into play is when the traditional credit insurers factors are either dropping or limiting coverage on a name. If it becomes too risky in their eyes, or they're reaching certain thresholds of risk, and they no longer want to add on to that risk, that's where we'll step in oftentimes and provide that coverage for the vendors. I think that's really, our business in a nutshell. We are an investment group that focuses on stressed and distressed accounts receivable and illiquid accounts receivable. And we provide solutions, whether it be liquidity on a bankruptcy claim, credit protection on accounts receivable on a risky account, purchasing of subrogation claims from insurance companies or otherwise, purchasing class action claims that companies might hold, and providing litigation finance. We provide all of the above